Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. How are you doing today, Sam?
Doing great. How are you doing, John?
Listen, Sam, I'm doing fantastically despite all the negative news that's out there. Literally, I mean, it's just no matter where you turn, it's bad story after bad story. Beth commented to me, as so much last night. It's just, but despite all that, I'm looking out the window right now, and here we are on October the 4th, 2023 in central Alabama, and the weather couldn't be more beautiful. Even so, there are a lot of investors out there that are going, hey, Norris, the weather might be nice in Birmingham, but these higher interest rates are starting to kill my investment portfolio.
Yeah, you're right on both accounts that it does seem like things maybe aren't as bad as some people would expect them to be based on the news. But there definitely is some areas that are causing pain. But, you mentioned bond markets rallying. That's causing a lot of pain for a lot of people. But still, even the stock market's kind of going step for step with that right now. But it's 9% off its all-time highs right now. So we got to take a step back.
We have seen some of the asset classes give up a lot of their return really over the last couple of months and last 2 months, and then the first week here in October. I think mid-cap's down to maybe barely positive for the year, same large, except for small-cap tech stocks are still largely positive. However, when you really take a look at it, and this is something that you don't probably see on the headlines too much, if all you know about the stock market is just paying attention to the headlines on the CBS Evening News, you probably wouldn't know, frankly, that the 10-year Treasury has moved as much as it has. And ultimately, stocks react to interest rates much more so than interest rates react to stocks.
Yeah. I guess it's partially the circle we're kind of in, but it seems like
the circle of life, I think you're calling it.
The circle of life for us in the investment industry, it's all that's being talked about now. Yeah. And working at a bank, probably escalates that even a little bit more so. But you're right. I mean, I think outside of it, most people are talking about the political, shenanigans going on. That's
we can talk about that in a few minutes, but shenanigans is a perfect word for it.
But you're right. I mean, it impacts really everything.
And what we've seen really since the beginning of August is a sharp increase in longer-term rates. And while I think if I'm not mistaken, the 10-year U.S. 10-year Treasury yield, or the yield of maturity on the U.S. 10-year, has backed up around 70 basis points in a couple months, thereabouts. I mean, give or take a few basis points. And that might not sound like a lot to the average investor or just the average person walking down the street. Sam, that's a huge move on the long end of the curve in a very short period of time. And people are wondering, and I've gotten asked plenty of questions, exactly what is causing this. What do you think is causing it? And maybe we've got some trading perspectives.
Well, we kind of hit on this a little bit, or what I thought it was going to be before we may not be done with rates going up, but we've seen it. And since, we talked about it, and what I've been very almost hard-headed in believing is the cause of what it would be and now what it is the close to $2 trillion the federal government is really going to have to borrow through the back half of the year. Really, I told you I was looking for some kind of supply catalyst. More supply means prices go down, means yields go up. Pretty simple stuff. That's a lot of supply, especially more in the longer term parts of the curve, which is really where supply can impact rates more. On the short end, it really doesn't impact it as much. It's risk-free rates.
Well, it's almost more constant demand. You're talking about 3-month sort of maturities. People aren't too worried about that. But you start throwing money out there 10, 15 years, you want to get a little bit better idea about what's going to happen.
You have a term premium, you have risk associated with it, and it's not just the risk-free rate of return. But we're going to have a lot of that. We have had a lot of that, and that is going to continue. That, to me, is by far the biggest cause of it. I think, you have other things, and we may disagree on that being the biggest cause of it. The economy's still been pretty strong for the most part. The Federal Reserve continues to think that they're not going to have to cut rates as much or position themselves as not having to cut rates. So kind of everything in the news is pointing towards rates should probably be a little higher. I can't think of many things that...
It's really hard for me to make a solid case for interest rates to go lower from here. And someone just asked me a question. I was in a meeting earlier this morning, and someone asked me what in the world's going on with longer-term rates. It's kind of a weird meeting to be getting that question. But I started off by pretty much saying what you said. For long years, it seemed as though the U.S. Treasury market was immune to good old-fashioned Econ 101, and that's being supply and demand. The U.S. Treasury could just issue as much as it want, people would gobble about, and interest rates would remain low. You touched on it. When prices go up, interest rates go down. So if interest rates are low, that means someone's gobbling this stuff up, and people did. However, when you peel back the layers of the onion, you find out something, Sam, that really over the last 15 years, and I mean, that's about right, really, the Federal Reserve and foreign investors have proved to be a very mighty backstop just in general. It doesn't appear as though domestic investors, outside of insurance companies and banks, really have much of an appetite for Treasury debt or government debt in any real way. So when we start thinking about things, and the Federal Reserve is now actively trying to shrink its balance sheet, I think about $900 billion is kind of the trailing 12-month number, $800 billion. The Chinese aren't buying anywhere near the same number of treasuries, and while foreigners still own a lot of them, they're not gobbling them up at the same pace that they were. So that leaves it on the domestic markets in order to purchase all these things. And so when you keep flooding the markets with it, all of a sudden the supply is going up faster than the demand is.
Yep.
And as a result, that's just when prices fall, when supply goes up faster than demand, and when prices fall, interest rates go up in the bond market. It's just math.
Yeah, and you hit on it first with China and foreign markets, and it's hard to get real clear on what exactly they're buying. They can domicile them in Europe, and they can buy agencies and what have you, but they're most likely buying a lot less. And
yes.
Banks.
Officially, they are.
Officially. And banks are the other one. Banks are a significant player in interest rates and some of the biggest buyers of longer-term debt in the markets. And it's hard to imagine. I mean, we talked about the banking crisis in March, and, some banks are benefiting from that. Some are still probably, kind of iffy or what have you. But I don't know a ton that are probably going out and saying we are fine taking all this duration risk, taking risk in our investment portfolio right now. So that's, again, taking out, you kind of hit on it, but I wanted to expand on taking out another massive player. Well, probably the third biggest.
It's certainly on up there. And you bring up a very good point. It's been such a long period of time when we've been in a period of structural higher interest rates. And we've seen this really over the last 24 months, that there's virtually no one in any CFO's office or anyone that's buying bonds for a bank portfolio that has ever seen the backup in rates that we've seen over a relatively compressed period of time. And so what has happened to bank balance sheets as interest rates have gone up, their bond portfolios have gone down in value. And when that happens, the good old book value goes down as well as bank capital.
Right.
So there aren't probably very many CFO's offices saying, hey, why don't you go out and give me some 10-year paper? Why don't you go out and give me some 15-year paper? Because they've seen what happens when interest rates go up. All of a sudden has a really negative impact on their balance sheet. And why would you want to do that right now when they're not stretching for yield? You can actually make as much on a 2-year treasury, if not more, than you can on longer term paper. So I would imagine what's happening is a lot of that money that banks have out there, they're keeping it in bills and they're keeping it in the 2-year, 3-year maybe, but they're not stretching out there for yield the same way they were this time last year.
No, because really the only two reasons, the two best reasons I can probably come up with was why you would buy longer term rates or longer term debt is one, the easy one being you have to if you're an insurance company or what have you, duration, matching duration. That's always going to be there.
Yeah.
There's going to be some that are kind of just price takers on that. The second would be for some kind of trade if you think, the economy is going to collapse and then you make a killing on all this duration. But banks, especially now, aren't probably looking for their investment portfolio to be where they're making a ton of profit.
No, what they're looking for their investment portfolio is not to go down.
Exactly. It's the complete opposite
of where they were this time last year. So that leaves us to the domestic investor by mom and pop, Joe Sixpack and John and Jane Doe, whatever you want to call them. And that begs the question, just what do individual investors need to see before they start getting attracted to go back into debt? And, Sam, here at Oakworth Capital Bank, we've been underweight fixed income for an extended period of time, as you well know. And when I take a look at the markets, it's hard for me to sit there and say, a 10-year treasury that's backed up to 4.8, 4.9%, or wherever we are this morning, rallying a little bit this morning, is that still attractive? And understand not everyone's going out and buying 10-year treasuries, but they kind of set the tone for the majority of the market out there on the curve. is that attractive enough? And I've got to tell you, if I'm looking at things, I'm going, okay, historically, investors have demanded about a 2% premium over inflation on intermediate term treasuries or intermediate term bonds. And with the trailing CPI at 3.7%, I could argue that, someplace in the mid fives right now is about where I think sort of the market equilibrium is, where individual investors, banks might even get more attractive, so might even find it more attractive. So I'm thinking we got a little ways to go here yet, just based on past observations. I gotta say, past performance is not indicative of future results, but you have to ask yourself as an individual investor, is it worth me putting my money out in 10 plus years at sub 5%? And I would imagine now that people have gotten used to the new interest rate structure, where now really people are thinking a little bit more soberly about it. The thing is, no, I don't want to put my money out there for 10 years at less than 5%. I'm going to need to see more than that. And that's what I think is going to be ultimately help to push interest rates up a little bit, even a little bit more higher. Did I just butcher the English language there? Even a little higher there than just the sheer supply that we have already.
I think I'm pretty much with you, and just a little little less so. In that I think not to peg a number where it reaches its high point, but I think 5% can really change a lot of things.
Well, it's a psychological.
It's a psychological thing. It also gets close to, not to get too nerdy, but the inflation expectations for 5 to 10 years out, so not these next couple of years, is still
you have to be careful when you talk like that, because you'll get to my age and not get invited to parties any longer.
Talking about the 5 year forward inflation expectation break evens. But no, that's still about 2.5% right now. That's been pretty. It really hasn't moved even through these last couple of years of inflation. The market still is comfortable that's going to. So that gets us close to 2.5% over where they think inflation expectations will be over that long term. So again, you still have it in the intermediate, in the short term, but I think things may start to change with a 5 handle. But it just seems like it's going that way.
Well, that leads me to the last thing. There are a lot of things that kind of go into it. Domestic demand, the demand for a real rate of return, the amount of supply, and then third, you mentioned it a little bit earlier, the shenanigans that we're having in Washington.
Yeah.
Make no mistake about it, we borrow a lot of money from around the world, and U.S. Treasury debt is nothing more than Washington's ability to finance its deficits. And you could say interest rates are what investors feel about the U.S.'s ability not only repay its debt, but its willingness to repay its debt as well. So when we see out there domestic investors and increasingly international investors see what's going on in Washington with this particular Congress, and really what's been going on for the last decade, or more, the sniping and the backbiting, the willingness to work with one another, the extremes of both primary parties really, calling the narrative, whichever way you are. If I'm a foreign investor, I'm beginning to think, okay, the 5% yield kind of looks okay, but just how willing is Washington going to be in order to make sure that I get my money back? And that's a much more difficult question, I think, than it would have been 10 years ago, although I still think the U.S. will service its debt. I think we all do.
Yeah.
But if I'm a foreign investor and maybe I've got other alternatives, perhaps the U.S. does not look to be as good as or as much of a slam dunk as it once was.
Yeah, I mean, you talked about it's gone on for a little while, but even what happened yesterday, I mean, that was history. It was the first time that's happened. The shortest serving Speaker of the House since, I think, 1876 or something.
Well, it's very frustrating. You have a member of one party that doesn't like something that the Speaker does. So, by gosh, we're going to have, for all intents and purposes, a vote of no confidence on them. And of course, the opposing party is going to vote the guy out.
Yeah. They had a gift given to them on
just
a silver
an absolute
platter.
gift given to the opposition. And in Parliament, it might not, in the UK and elsewhere, it might not work that way because they're frankly more investment. They're more political parties to kind of split things up. And then also, I wouldn't imagine political parties elsewhere are as fractious as or as fractured as the Republican Party is right now. So when we take a look at all these things, the sheer supply, investor demand for an absolute rate of return, and then also, frankly, shenanigans. I don't know, Sam. I don't know where resistance is. I don't know if anyone knows where resistance is. I can still make a better worst case scenario for bonds than I can a best case scenario for them.
think that's probably fair.
Oh, come on. You got to say more than that.
I think that's probably fair. I think the big, why you would be long-term bonds or longish, talking roughly the 10 years, starts to become attractive if you are afraid that the economy is going to collapse.
Yeah.
That is really, to me, that it sounds weird saying the bull case for bonds, but I kind of think that's it. And it doesn't have to be a 2008 or a 1931 or something, but a drawdown in the economy, a significant enough one to draw demand out to the curve a little bit.
Well, we could all see that happen. It would make obvious. It would be logical sense that a higher cost of money ultimately slows down the U.S. economy. Even so, there's still plenty of liquidity out there. Still enough credit extension, combination of the traditional banking sector coupled with private equity, and then also what insurance companies are doing now with their mountain of cash. That I don't think we're going to see the same level of credit crunch that we saw in 2008. But then, on a more positive note, the U.S. economy has had significantly higher rates than what we currently have now, and been able to thrive and grow. We will be able to get through this, even if it does mean that we'll have a slightly lower than potential rate of growth, probably for the next several years. But then after that, investors and businesses will get used to the higher cost of money, and then we can ultimately move forward, because ultimately it does come down to what you can make on the other side. Mm-hmm. If the price of money is 10%, but I can get 17%, why do I care?
It doesn't matter.
It doesn't matter. But if the price of money is 1%, I can only get 2%, which is a better deal. I think the answer is obvious to that. So the absolute cost of money isn't the issue; it's the potential for rate of return on the other side.
Yeah. I think it'll be, you mentioned the next couple of years, and that's the obvious question is how much higher interest rates, slow down the economy. And there's obvious parts of it that it will, commercial real estate, things like that. I mean, are purely interest rate driven.
Yeah.
The U.S. consumer, while it is interest rate driven, there is, credit card debt, there is consumer debt in general, buying residential houses, what have you. I wonder how much the amount of wealth stored in the baby boomer generation that is going to have to be transferred, spent, or otherwise used is going to be able to outlast that. Because you and I talked about it yesterday about a certain individual, and we started talking about how some people have benefited from high rates.
Yes.
There's some people that it's been great. They have hundreds of millions of dollars of cash. They were making nothing on it. Now they're making millions and millions of dollars a year doing nothing different.
Well, you can think about people living on Social Security that are taking interest off their CD portfolios and what have you. There are plenty of people out there doing that. Baby boomers and people even in the silent generation that have been dependent on higher interest rates, and now they've got a little bit more cash. It's not going to completely offset maybe some of the slowdown in consumer expenditures. But the thing is, higher interest rates can also cause some virtuous behavior in the fact that it forces people to save a little bit more.
Yeah.
Maybe not spend so much. That might sound crazy, and certainly anathema for short-term U.S. growth, but you're never going to be able to convince me that investing is not good for the long-term health of any economy or even any society. Yeah. So some short-term pain as we get adjusted to these higher interest rates, but longer-term, I think it's going to be okay.
Yeah.
Which leads me to my final question before we cut things off here today. And this is going to be a generational deal.
Okay.
And talking about the shenanigans that went on in Washington yesterday with removing Speaker of the House McCarthy. What is your generation? How do they interpret this? Do they interpret this as just normal behavior? Or are they interpreting moves like this and what's going on in Washington this year as really not sustainable over the long term?
I almost think it's viewed as the norm. As we mentioned, what happened yesterday being history, but I don't, at least to me and probably the people I'm around, it doesn't feel, it was a little shocking at first. It almost felt like before the vote that either way this went was going to shock me.
Yeah.
But it almost seems like status quo at this point. It seems like that's the direction things have gone. And since I've been able to vote and have been aware of politics, I view my generation getting closer to when we talked about Europe and culture over there, how a lot of younger people there just really don't care about politics.
Yeah.
I think we're shifting more towards that, at least locally, at least the people I'm around. I know there's always going to be fanatical people about it, but it's just so silly, and we've seen older generations get so up in arms about stuff they can't change in social media and just getting fired up, and I'm just kind of tired of it, and I can't do anything about it outside of vote.
That's great commentary. It really is. And maybe I shouldn't speak for my entire generation, but it's disappointing more than anything else. And watching that, everything that's kind of played out, it's disappointing for me as a member of Gen X, kind of one of the older members of Gen X, actually, born in 1968, to sit there and take a look at this with all the problems that are facing our country right now, and just the games that these people were playing in order to appeal to a small element of their, electorate, is very frustrating.
Yeah.
It's very frustrating that a guy like Matt Gaetz gets or whatnot.
Yeah.
Surely he's pandering to some small element.
I saw his face after, and it looked like he got exactly what he wanted with the 1,000 cameras around
and so it's he's doing this for something, but it's not for the benefit of the country. I think it's for his benefit more than anything else. And there are far too many people in Washington that are doing that type of thing, saying outrageous things in order to make sure that they get enough likes and clicks and enough airtime and enough posts. And I've had enough. It's never thought I'd say I wish we're going back to the days of Tip O'Neill and Moynihan out in New York, but at least there's the people we all felt were moving all in the same direction, and that's for the betterment of the country as opposed to the betterment of themselves. So that's my personal take. And you also have to remember, Sam, no matter what we say here at Trading Perspectives, they are our opinions and our opinions alone. And also anything that we say that out there about the market should not be construed as an offer to buy or sell investment securities or investment services of any kind. Any actions that you take after listening to Trading Perspectives, you do so at your own peril. All that good stuff. We got a whole list of caveats out there. Essentially, if you do anything after listening to Trading Perspectives, you do so on your own. And then also our comments and opinions are those of Sam and myself only, not necessarily those of Oakworth Capital Bank, any of its other shareholders, associates, board of directors, stakeholders, or anything of any nature. With that also, one more thing, Sam. We'll always love to hear from y'all. So if you have any comments or questions, please, by all means, let us know. You can always reach us at dropping us a line at tradingperspectives@oakworth.com, where you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we got to say or how we think, you can always go to oakworth.com, OAKWORTH.com. Take a look underneath the Thought Leadership tab and find all kinds of exciting information, including links to previous Trading Perspectives podcasts, as well as links to our newsletter/blog, Common Sense, as well as links to our upcoming, well, the links aren't there, but they soon will be upcoming, links to our third quarter magazine, Macro and Market, which I know is full of all kinds of good stuff. With that being said, Sam, you got anything else to say on these topics?
That's all I got.
That's all I've got today, too. Y'all take care.